Hi, this is Danielle DiMartino Booth, and I am the founder, CEO, and chief strategist of QI Research. I'd like to thank you for taking a few minutes to watch this short segment and hear my latest thoughts on the markets and the economy, and of course, monetary policy here in the United States. Thank you for your feedback. Please, if you don't already follow me on YouTube, please do so and invite your friends to come and watch as well. Take care. Bye-bye.
Let's bring in QI Research CEO and Chief Strategist Danielle DiMartino Booth. First, your reaction to this initial reaction to the Fed, what we heard so far.
Well, I think that they're going in this in the way that they want to be balanced. They're saying we're not leaning on one side or the other. The last few meetings, they've been leaning on the employment mandate and saying so. But in this particular statement, they said that we see the risks as being balanced between our inflation and our employment mandate. And I think he's going to stick to saying that balance means we are data dependent.
All right, but here's some data for you. You cut rates. You're supposed to, slow the economy down. Instead, it goes up, really up, and it stays up. So, I mean, did they make a mistake? Is it too early to say, or what do you think?
I don't think they've made a mistake because you have to ask how the consumer's been powering their spending. And if you popped up another chart of credit card spending, then you would see how that has occurred. Because as we're seeing with the Employment Cost Index, which is the Fed's favored measure, wage growth is indeed coming down. So how are they supporting their spending? By borrowing more.
Right. And you keep warning against that. I was looking at your note, and there's something interesting jumped out. You mentioned ISM services. I thought maybe you mentioned ISM manufacturing, which has been a disaster in my opinion. But this number came out, and what we saw was an improvement in the overall number, 56 from 54.4, a little bit of improvement in prices, a big improvement in employment, right, from contraction to expansion. But you say, no, we're all looking at the wrong thing. We should be looking at this line, right, the orders, right, the backlog.
We should be looking at the backlogs. Remember, in September, according to Macro Edge, we saw announced layoffs cut in half to 50,000. They popped back up to almost 110,000 in October. So we were expecting the September reprieve in layoffs to manifest in a lot of these surveys. It did, but what's behind it? Not much. Backlogs are a sign of pent-up demand, and they're the number one precursor to future employment. So what we're saying is this bump in employment is going to be short-lived, as we've seen with one company after another announcing layoffs this earnings season.
Great point. So, okay, we've got the backlogs. Four of them.
1, 2, 3, 4.
Right. Those are the only ones that say we had an increase in order backlog. Everyone else, from agriculture, professional, construction, retail, public administration, healthcare, and these, by the way, are big,
huge sectors. They're big sectors, and in economic speak, we call this halitosis. This is bad breath. BREADTH.
Right.
And that's what we're seeing, and it means that we're not seeing widespread strength across the services economy that is 80% of the U.S. economy.
And by the way, the service economy is what, to your point, is what's kept us buoyant, right? Because the manufacturing data has been a mitigated
disaster.
Got to ask about credit card spending, right? So here, late last month, it was mostly green, not too bad. But so far, I got to tell you, I'm sorry, let me go back to that. So far, November has been a disaster. It's all red, almost across the board. Have people finally tapped out?
I think we're starting to see signs of that. When the big banks came out of the gate at the beginning of the earnings season and announced billions and billions of dollars in credit card charge-offs, that means that they're going to be much stingier in terms of extending credit to households. We're seeing that manifest in the weekly real-time data from Bank of America here.
But I think it's the total card spending is going down, right?
Down.
And of course, that means people, maybe to your point.
And credit card spending is negative. Debit card spending is positive. But that means what I'm spending on groceries and gas, right? That's what you're spending with your paycheck. But credit card spending, that's discretionary. Those are things that you want to buy. And by the way, the holidays are coming, and we're seeing discretionary spending take a hit.
Not a good way to go into it. Hey, you going to stick around for the Q&A?
Of course.
All right,
Super
thank you.
Bowl Fed
The great Danielle DiMartino Booth. Well,